On Canberra Live with Leon Delaney. Money Matters with Luke Smith from Envision Financial Services.
Luke Smith, good afternoon.
Good afternoon.
I don't know about those showers because I can see blue skies and sunshine now.
You know, it's actually it cleared up some sort of lunchtime-ish, and it's actually really nice out there. It's
It is
great
quite
to
nice, yeah.
see the rain
absolutely.
coming. You know what? It can rain all night, beautiful, and then it can stop during the day, even better.
Even better, that's right, exactly. Here we are today. I believe, looking at today's topic, it seems to be a follow-up from last week's discussion about the difference between deductible and non-deductible contributions into your superannuation. So today, the question we're asking is, how do we get a deduction? And so what is the notice of intent and why do you need it?
Yeah, look, exactly. And we're just going to prepare this theme and continue the contribution methodology of getting ready for 30 June because it's sneaking up week by week. And we say every week, oh, wow, it's Friday again.
Today is the 23rd of May. So that means 1 week and 1 month until the end of June.
Correct, but not even because the 30th is a Monday.
Oh,
so
yeah.
the 29th and 28th are the weekend, which would mean most funds, you would want your contribution cleared by the middle of that sort of 24th, 25th.
Yes,
so
just to make sure you've got it all there.
Gives us even less time to be sure. So today's topic is, what is the notice of intent? When do I need to use it? And why do I need it? Because it's always a point of confusion when I discuss people putting money into super because they say, oh, my work will claim the deduction. No. So if we take a step back and say a personal contribution is where you use your own money to add to superannuation. Now you have a choice to claim a deduction or not claim a deduction. And today we're going to talk about the paperwork required to be able to ensure you get the deduction that you want. So we've spoken in the past about the $30,000 limit, and we'll continue that theme today just for simplicity. You've got $30,000 cap. You've had $15,000 from your employer by way of superannuation guarantee, which would mean you have $15,000 of what we call cap space. Now, a few different ways you can use up that cap space. You could start a salary sacrifice program from the 1st of July and salary sacrifice through to 30 June to add that 15 grand in out of your wages. If you do that, your work claims the deduction. The second way you can soak that up is to use your own money and put $15,000 into the super fund. Then here comes along the need for the notice of intent. The notice of intent tells the super fund where you've put your money, hey, Mr. Super Fund, I intend to claim a tax deduction myself for the $15,000 that I've put in out of my own pocket. What happens is your cash goes into the fund, step one. Step two, you get a notice of intent. It's an ATO produced form. It's a standard form that all super funds will accept. And on that form, you put your tax file number, your personal details, and the fund that you have put the money into. So you'll need the fund name, you need the USI, you'll need the ABN, all publicly available information with a quick Google. On the second page, what you need to then say is, which financial year am I claiming the deduction? So for this year, it would be 2025. And then in the middle of the second page, it says, what is the amount of money you have put into the fund? In this example, it would be $15,000. The next line on the document says, how much would you like to claim as a tax deduction? In this example, we would write $15,000. So generally speaking, the numbers in the two boxes, I think it's questions 13 and 14 of the document, they should match. Then you sign it and you send it to the fund where you have already put in the money. Don't send it before the cash. And don't send it too late after you've put in the cash, because if the super fund's done their tax return and you're in an industry fund or a retail fund, they will not amend the tax return and you miss out on your deduction. So I always say to people, if you put the money in on the 1st of June, send in your notice on the 2nd of June, and then you won't forget. You don't have to wait to July, but you must lodge the form after the money has gone in. The reason we need the form is all super funds will assume that personal money is a tax-free contribution by default. But if we want a deduction, as the name of the form says, we are notifying you of our intention to claim a deduction. So money in, completed form in, then the fund will write back to you and they'll say, hey, Leon, thanks very much for your notice. We will remit the tax to the ATO for you. Now, it is advisable that you keep that notification, because if the ATO ever comes knocking and says, prove you did it, you need to be able to produce that if questioned. I would also, as a best practice, give your accountant the confirmation from the fund and give your accountant a copy of the notice of intent that you have lodged. The reason that part of the process is important is you could put the money in, you could then potentially have the right to pull the money out. And if you were going to do that, for example, if you wanted to put the money in and then start a pension, you need to ensure that the deduction has been recognised from the fund. Because if you pull the money out or start a pension before that's been processed, you could miss out on the tax deduction because of the timing of you taking out the money, rolling over the money, or starting a pension with the money, depending on what you're planning on doing. So the details here really matter to ensure the continuity of the process, but also the continuity of the deduction and the primary benefit for the purpose with which you're trying to achieve the outcome that you're after.
Okay, so during that process, you said that there are two questions on the form where you tell the super fund, first of all, how much money you're putting in, and second of all, how much you're claiming a tax deduction for.
Correct.
And you said that normally those two numbers would be the same. But I'm assuming if for some reason you wanted to claim a tax deduction only on part of that money, then you could also do that if you choose.
Exactly right. So let's extend the example. Let's say we put in $100,000. Now, if we put $100,000 in, we might want to claim $15,000 as a deduction, and the $85,000 goes in as a non-concessional contribution. So in that example, what have I put in? $100,000. What do I want to claim? 15. That way we've separated the two types of contribution and we've given the super fund clear indication of the amount that they need to remit the tax on. The other thing that you can do, and I get this one a lot, is, well, I put a contribution in every month. Do I need to lodge a form every month? No. You can, but it'd be a headache. I'd advise that you make your contributions during the year and then give one form to the fund for simplicity that encompasses all of the contributions that you've made during that financial year to achieve the deduction level that you're after. But you are spot on. You can put in more and claim less. I generally find that people don't worry about that because the non-concessional contribution is actioned anyway. They try and keep the figures consistent to avoid any sort of administrative misunderstanding at an industry fund or some of these others that are a little bit questionable when it comes to actually being accurate.
So in other words, keep it simple.
Very much so.
Yeah.
If you can limit somebody's if you can limit the damage done by a call centre, you've got a greater chance of getting
reduce the opportunities for misunderstanding.
Totally.
Yeah.
Exactly right.
Now, so you've just said that I could potentially make contributions monthly throughout the entire financial year. So I'm putting forward 12 regular instalments, but I don't need to put in the notice of intent until after I've made that 12th payment, but before the end of the financial year so that it's there in plenty of time.
That's exactly right. And again, you don't have to lodge this form by the 30th of June. You can lodge it later or early in the new financial year. But again, let's not open the door to forgetting. Let's not open the door to assuming. Let's not open the door to, I need to send it in November, but the super fund's already lodged their tax return, because a large retail fund or an industry fund's not amending your deduction. And then you'll get upset because you've put money into an environment that you can't get back out for a number of years potentially, and you've got no tax benefit for foregoing that capital. So again, let's keep it simple. Money in, form in. If you do it during the year, you can, but send in one form at the end of the year. Because if you do a monthly one, you might need to amend previous paperwork, and then now you're opening up the door to more administrative confusion. And the last thing you need at 30 June, on top of all of the other pressures, is to redo something and remember a contribution that you might have made in July last year when you can't remember what you had for lunch 3 days ago.
Okay, I suppose you don't have to make monthly contributions. You could just put the money aside in a separate bank account all year and then make 100%. One contribution when the time is right, and that actually simplifies the process a bit.
Great strategy, right? So I'd say to people, where you have a mortgage, fill up the offset account of your house all year, reduce the interest incurred on a non-deductible debt, then pull the money out in June from your offset account, make your super contribution, potentially get a refund, bank that refund back in your offset account, and you've had 2 uses for the same $15,000, you could argue, and you've got strategic control over your cash flow for the situation where that's appropriate. Look, if you're a spending maniac and you've got stuff turning up at the house from FedEx and your partner, your wife, your husband, your significant other is on first name basis with the FedEx man, well, you know what? Go to your work on the 1st of July and say, hey, I need to get $15,000 in. Can I do $1,100 a month or whatever the figure is, so that you don't have to think about it? You can also do that. But it's very difficult with 4 weeks to go in the financial year to salary sacrifice 15, 20, 30, 40,000. So personal deductible contributions are great where you're going to make lumpy contributions late in the year and you can't salary sacrifice because you just don't earn that amount of money to direct all of that to super. But again, if you're a spending maniac, and there's nothing wrong with that, right? I'm pro spend.
I know. I've seen you.
I'm pro spend, but save yourself from yourself. Go to work 1st of July and say, hey, HR people, can you get this amount of money into my super fund, please? And salary sacrifice old school.
Yes.
Can we go old school, please? And then you don't have to think about it. If that's going to get the money in there over you coming to me in June and going, yeah, Lukey, and I just look you in the eyes and go, you've spent it, haven't you? And you go, yeah. Save yourself from yourself. I'm great with automation. I think automation is our friend. And the lack of engagement that you need to be part of something, the greater the continuity of what you're going to execute and the consistency going forwards.
Luke Smith from Envision Financial is with me in the studio today, and today we're talking about how to get a deduction and what the notice of intent is and why you need it. It's about 11 minutes to 5. We'll be back with more in just a moment. Seven minutes to 5 now. It's a Friday afternoon, so Luke Smith from Envision Financial is with me in the studio. And today we're talking about your tax deduction when you make a contribution to your superannuation fund, and in particular the importance of the paperwork and why you have to get it right.
You know what? Details matter, and there will definitely be some tears over getting this paperwork wrong, because you'll be very excited about, I'm going to get a refund. The refund doesn't come and you can't work out why. It's generally because you haven't lodged the notice of intent where you've made a personal contribution. So, if we want to break down the process, find out how much room you've got, call the fund, or log on to MyGov, because they will keep a record of your cap space. Get the money in the fund, number one. Number two, download and complete the notice of intent, sign it, get it right. Now, it goes to where you have put the money. It doesn't go to your accountant. It doesn't go to your bookkeeper. It doesn't go to HR at work. It goes to the fund that has been given the money. So, fund, money, form, confirmation. Keep that. The fund will write back to you and say, hey, Leon, thanks for that. We will remit the tax for you. Keep that correspondence from the fund. Your accountant will want it. Keep a copy of the notice of intent. Your accountant will want it. Best practice, okay? Make sure you don't leave the form too late. If you put the money in, do it while you're thinking about it, because, I'll do that in July becomes, whoops, I wish I'd done it, okay? Make sure that you know how much room you have. don't guess. Ensure you are aware that if you have multiple funds and you make multiple contributions, that is multiple notices of intent. Okay, so I've got 2 funds. In the example before the ad break, we had 15,000 going in. If I do 5 to Fund A and 10 to Fund B, notice of intent to Fund A for 5. Notice of intent to Fund B for 10. Not 15 to one fund, because they will not talk to each other. Okay? If you make multiple contributions, send in one at the end of the year. You don't need to be doing it for every contribution during the year. The form will do your head in. All right? So one at the end for the total contributions, and don't pull any money out, start a pension or do something else with that vehicle until the confirmation has been received that your contribution has been processed. Then you can pull money out, then you can start a pension, then you can do whatever you're planning on doing. But if you do it before they've confirmed that deduction or before you've lodged that notice of intent, highly likely you will miss out on the tax saving that you're doing it for. And then there's some more tiers. So the details matter with this one. Get it right, and then you'll get a great outcome for the strategy that you're trying to execute.
Okay, so make sure you don't forget the paperwork and make sure you get it right.
100%.
There we go. Where can listeners get more information?
Yeah, office number 62604749. We've got envisionfinancial.com.au on the internet. That's Envision with an E. We've got the podcast, The Strategy Stacker. Luke Talks Money on iTunes and Spotify. And we've got Envision Financial Canberra on YouTube, where you can subscribe to the YouTube channel and get a backlog of all of our shows where you can watch them on your phone or your iPad. And you can read it all in Smart Money Strategy. There is an actual chapter on a notice of intent, because it's the one thing that people seem to either not understand or get wrong more often than not.
So that's the smart thing to do. Get a hold of a copy of Smart Money Strategy. Luke, thanks so much.
See you next week.
We'll catch you again next Friday afternoon. Luke Smith from Envision Financial back with us again at the same time next week to talk financial matters once again.